You bought something from at least 4 of these 7 companies this month, and every single time, the thing you swiped your card for was the side business. The product was the doorway. The money was standing one room behind it. Over the next 9 minutes, I'm going to walk you through 7 of the largest companies on Earth and show you where their profit actually comes from, using the numbers they filed themselves. A few of these will irritate you. One of them, the 7th, collects more cash from a credit card company than it makes an operating profit from flying human beings across the country. And once you see how that trick works, you will never open your airline app the same way again. Stay with me for that one, because it is also the one that explains the other 6. And when we get to the end, I am going to show you the same machine sitting inside your own paycheck, pointed in the wrong direction. Let's start with the one you have probably stood inside on a Saturday. Costco moved about $270 billion of merchandise last year. Groceries, tires, a kayak you did not plan on owning. And the company runs on a rule most retailers would call insane. No item gets marked up more than 14% over what Costco paid for it. 15 if it wears the Kirkland label. The hot dog and soda combo has cost $1.50 since 1985, and management has said out loud it will stay there. So where does the profit live? Last year, Costco earned about $8.1 billion. Membership fees brought in $5.3 billion of that. 2 out of every $3 of profit came from the card in your wallet that grants you permission to walk through the door. 92% of North American members renew. The warehouse is bait. The annual fee is the business, and every absurdly cheap price you walk past is money spent making sure you sign up again next year. Now look down at your shoes. Nike sold $46.3 billion of product last year and does not own a single factory that makes any of it. 0. As of last May, 97 finished footwear factories across 11 countries built Nike's shoes, run by 15 contract manufacturers whose names you have never heard. Roughly half of everything came out of Vietnam. Nike's actual operation is a design studio and a story department. Their own income statement has a line item for it called demand creation, which is the polite accounting term for making you want things, and last year it ran $4.7 billion. Athletes, campaigns, drops, the swoosh on a stadium. That spending is the product. The physical shoe is a commodity that anyone with a factory can produce, and you can buy nearly the same construction for $60. What you paid for sits on the side of the shoe and inside your head. The next one charges you nothing for the trick and gets you to do the work anyway. The group that runs most IKEA stores pulled in about 41.5 billion euros last year. Walk into one and you are dropped into a single winding path through a building the size of 5 football fields, with almost no shortcuts, and a typical visitor covers close to a mile before reaching a register. That is deliberate. In a normal store, you see maybe a third of the catalog. Here you see all of it, one room at a time, in a fake apartment that makes you feel behind on your own life. Shoppers who stop at the food court spend more than twice as much on furniture. Then comes the flat pack, which is the most profitable idea in the entire building. You drive the couch home. You spend Sunday assembling it. When they redesigned one sofa's packaging, they cut it in half, took 7,400 truckloads off the road, and dropped the price 14%. You supplied the warehouse, the delivery van, and the labor, and you thanked them for the savings. Number 4 is on your desk right now. Amazon looks like a store, and last year the store did about 18% of its business somewhere most customers never see. Amazon Web Services, the division that rents computing power to other companies, brought in $128 billion of revenue. That is 18% of sales. It produced $45.6 billion of operating income out of a company total, near $80 billion. 57% of Amazon's profit comes from a business you have never knowingly bought anything from. The app you ordered socks on is a customer machine that generates habit and cash. The profit engine is a wall of servers that quietly powers half the internet, probably including the software your employer makes you log into every morning. Your Prime package is a rounding error riding on the back of a utility company. Number 5 gets rich by turning customers away. Ferrari shipped 13,640 cars last year. Toyota builds more than that before lunch. Revenue came in around 7.1 billion euros, and net profit was 1.6 billion, which works out to roughly $130,000 of pure profit on every car that leaves the factory. To put that in scale, a mass-market automaker clears somewhere around $2,000 a vehicle. Ferrari earns 60 times more per car while building a rounding error's worth of them, and they hold that number by refusing. There are waiting lists measured in years. On the most exclusive models, you have to be approved, and being rich is not enough on its own. Every car maker on Earth is trying to sell you one more unit. This one built a business where selling more units is the thing that would destroy the value of the ones already sold. Number 6 holds more of your money than you realize. At last count, customers were sitting on about $1.85 billion loaded onto Starbucks cards in the app. Money that has already left your account and has not yet bought coffee. In banking terms, that is a deposit, except the depositor gets no interest, no statement, and no ability to spend it anywhere else on the planet. Starbucks gets to use it in the meantime. And then there is the part that turns a float into a gift. A slice of that money is never spent. A card in a drawer, an app you stopped opening, $4.11 stranded forever. Accountants call it breakage, and in a single recent year, Starbucks recognized more than $200 million of it as revenue. $200 million of coffee that was paid for and never poured. And now the one I promised you, the seventh, which is the strangest business model in this entire video. Delta is an airline the way a casino is a hotel. Last year, American Express paid Delta $8.2 billion in cash. Not passengers. One credit card company. That figure is about 14% of the airline's adjusted operating revenue. And here's the number that should stop you. It came to nearly 1.5 times Delta's entire adjusted operating income. The card partner handed over more money than the airline earned running a global airline. And Delta is not alone. American Airlines took in $6.2 billion from its card and partner deals last year. At Alaska, loyalty is about 16% of revenue. Delta expects around $9 billion this year and has said $10 billion is in reach. Here is the mechanism because it is beautiful and a little unsettling. Delta creates miles out of nothing. They are entries in a database, and Delta decides how many exist and what they are worth. Then Delta sells those miles in bulk to a bank. The bank gives them to you as a 100,000-point sign-up bonus, so you put your rent, your groceries, and your flights on their card. The bank collects a fee on every swipe from the merchant, plus interest from everyone who does not pay in full, and buys another pile of miles with the proceeds. You believe you are earning free travel. In the actual transaction, you are the reason the miles have value, and your spending is the product being sold. The planes still matter because the planes are what make the currency feel real. But the flights are the marketing budget for a financial services company wearing a uniform. 7 companies, 7 different answers, one shape underneath all of them. In every case, the visible product is the entrance, and the money is standing one layer behind it. A fee for access. A story you wear, your own Sunday afternoon. Other people's computing. Manufactured scarcity. Your money before you spend it. A currency invented and sold wholesale. None of these companies would survive on the obvious thing alone. Costco makes almost nothing selling groceries. Delta barely breaks even flying you. They all built a second layer, and the second layer is where the wealth is. So look at your own setup for a second, because you are running a one-layer business. You sell hours. Your employer buys hours. The day you stop showing up, the revenue stops that same day, and there is nothing standing behind the door. That is the entire difference between you and every company in this video, and it has nothing to do with talent or hours worked. It is structure. So here are 2 things you can do tonight, both free, both about 15 minutes. First, open your 401k or your brokerage app and look at what an S&P 500 index fund actually holds. Costco is in there, Nike, Amazon, Delta, Starbucks, all of them. Buying that fund puts you on the ownership side of the same machine you have been feeding since you were a teenager, and it is the fastest second layer a person with a job can build. Second, open your Notes app and write down one thing you already know how to do that could get paid more than once. Not another shift. Something that keeps earning on a Tuesday when you are asleep. You are going to buy from all 7 of these companies again next month, and that is fine. Costco will take your fee, Delta will sell your habits to a bank, and Starbucks will hold your $11. The only thing worth changing is which side of the counter you are standing on while it happens. If this made the machinery visible, subscribe. We turn the way money truly works into something you can see. I will see you in the next one.